So what about talking about the differences between, say, the residential and commercial space? And then how does growth and income differ between them? And then going on with that, when are you seeing people start turning towards commercial? And this is a hot one because of what's come out in the budget recently that we were talking about before, whereby all of the changes to negative gearing and all these proposals that are coming in, they're actually carving out commercial property and self-managed super funds as well, which is quite interesting. What are the differences between commercial, resi, growth, income? What does that look like?
Yeah, so really interesting. And over the last maybe 2 or 3 years, we had already started to see a little bit of a shift where maybe 4 years ago, if you had to mention the word commercial, someone would have run a mile and just screamed vacancy and looked the other way. Was slowly that kind of mindset has been started to shift, and it's actually formed part of a lot of people's plans. So they might have had a plan to accumulate 1 or 2, 3 maybe investment properties over a 10-year horizon, look to hold them for, I don't know, a decade or more than a decade, 2 decades, and then maybe potentially divest of 1 or 2 of those properties and then transition in towards more of a yield-orientated play, which for most investors, naturally the thought process goes towards commercial.
Welcome back to the Winners Playbook. Today, I'm with a special guest joining me today, which is Joey from Gameplan. So Joey is the head of strategy at Gameplans, and they actually are the biggest provider of property investment software in Australia, which a lot of buyers agents actually use when they're doing their planning for their clients. But Joey's going to be joining us today on the podcast, and we're going to be having a chat about property investment, I suppose, in general. Joey does a lot of podcasts, he's got a lot of experience, but also at the same point in time, he practices what he preaches, and he is an avid property investor himself as well. So thanks for being here, Joey, and looking forward to it, mate.
Mate, thanks so much for having me on. Can't wait.
Cool. Well, let's rip into it. Before we get into the topic of property investing, which is a real common one that we do work with our clients around, but it's obviously a contentious topic from the budget that has just come out, and property investors are quite nervous around some of the changes coming through with negative gearing and capital gains changes. But before we dig into that, give us a bit more about your background and maybe talking specifically around some of the own property investment journey that you've done and some of the work that you guys actually do at Gameplans and the types of professionals that you help.
Yeah, cool. So in terms of myself personally, I bought my first property in 2015. I would have been 21 at the time and bought something that, I had no real idea what I was doing. I was just kind of tossing some ideas around with Dad. And the original intent was to buy a property and then eventually sell it when I was ready to buy a family home. That was my dad's thought process in behind it. Coming from like an Italian background, I thought that was the right thing to do. No real science behind it. Managed to stumble into a 1-bedroom unit. Don't crucify me, just said it was a street back from the beach in Maroubra. I'm from Sydney. Oh, nice. So it was quite desirable from an owner-occupier standpoint. Never lived in the property. It's just been rented out from day one. It's more than doubled in value over that period. So I firstly want to debunk the myth that apartments can't grow, because I'm living proof that they can. And so, that basically begun the investing journey. And then, like most investors, got the light bulb moment when I got a call from the broker saying, hey, do you know that your property's grown in value from here to there and you can potentially buy another one and use no cash? I had no idea that, but for me, that was like, wow, I can just keep doing this. And so then eventually just I kept acquiring some properties when I could until I eventually wanted to do that whole owner-occupier piece where I divested of an asset to help me buy the owner-occupier, not the entire portfolio, just one property helped me get into my original owner-occupier that my wife and I did a full renovation on. We raised our first son in, and then we sold that for a nice CGT exempt gain, and then put that in as a nice big deposit on our now forever home, where we've just finished some pretty extensive renovations. We moved in a week before Christmas.
Right, heaps going on.
Yeah, lots going on. But now I'm settled in. Capacity shot as well with the owner-occupier in the portfolio at this point in time.
Yeah. No, that's interesting. So your journey is very different to a lot of people, because most commonly people go and buy the first home and they live in it. And that's sort of the traditional, I think, way people go. And a lot of it is influenced, I think, by your parents, and particularly, some coming from ethnic backgrounds. And I see even for my wife's family, and a lot of the influence in what they say and what you should do, because they did it, 20 or 30 years ago when, property was, whatever price it may be, and they've just sat on it over so many years and made huge amounts of money. It's an interesting one, but I think it's one that we might even talk a bit about, is particularly around the apartment side of things, because even in general, when I talk to clients, a lot of the time my preference is around like buying just freestanding home, not worrying about strata or any of those issues. But yeah, no doubt you can make money out of apartments. But I think the key thing that would be good to discuss there is, some of the do's and don'ts to look out for, supply issues and things like that. Because I suppose that particular property, was that a part of a big unit complex, your first one?
Nah, I think there's maybe 15 or something in the block.
Yeah.
So it's wasn't a huge complex. And like I said, it's more about the location, right? No one's moving Ruby Beach to be 5 minutes walk from the sand.
Yeah.
It's got some pretty desirable owner-occupier appeal.
Yeah. And then you've used the, obviously the CGT, well, not discount, but the PPR exemption essentially. So you have sold a PPR, didn't pay any tax on it.
Correct.
Which I think is an important thing to remember as well, because you see some professionals in other countries talking about property and the taxes associated with it. But Australia is one of those rare countries where they do actually have some neat rules, which in your situation you took advantage of, because you can sell your PPR entirely tax-free. And then there's also the 6-year rule, which you can move out of home, which I'm currently in the process of doing that. So I'm not up at the 6-year point yet, but I might look at selling our original principal residence, because I'll be able to sell it tax-free within the 6 years, even though it's now an investment. So although there's a lot of doom and gloom around what's just come out in the budget, there are still some neat rules that you can take advantage of here in Australia. And I didn't see any whispers or anything in the budget around, the 6-year rule and that being taken out, unless you've seen it.
No, I haven't seen anything yet, but who knows?
Who knows? Well, now that they're listening, maybe they're listening to the podcast and they're going to hit it. So that could happen. But what about talking specifically with Gameplan? So what does Gameplans actually do? Because that's something that we've been looking at within our business with clients that we're working with around property. But what does Gameplans do, and what are you guys in helping businesses out with and helping clients with, I suppose, their own property portfolio? Yeah,
beautiful. So effectively, we host a portfolio planning piece of software that basically gives businesses the ability to provide clarity to their clients. Right. So if you're an end user listening to us, you may have bought a property through a buyer's agent in the past, and maybe you've had access to game plans in the past, but effectively we just want to give the ability for the client to put together a roadmap and a blueprint of how they can potentially get to their end outcomes through property. What's possible? If I want to try and achieve $2K a week of passive income through property, do I need 48 properties or do I need 3? Spoiler alert, it's not 48 like some people think that it is. Just that we can show them that, hey, if you buy one acquisition, these are the impacts. This is the impact to your cash, to your cash flow, to your equity position. Then if you did that again in 3 years' time, and then you multiply that out over a 15-year hold, look at your wealth position accumulate, look at your cash flow position map out. So ultimately it's to give that client clarity that, hey, the decision that we're making now is going to impact me in X, Y, Z factor, and ultimately produce a return of this in however many years' time before they jump in and make that acquisition. Because we know, property is a pretty costly exercise to get in and out of, with stamp duty, purchasing costs, BA fees on the way in, and then your selling costs, marketing fees, and CGT on the way out. So we would rather you stress test the ideas in your head first, put it in on the platform, see if that resonates before you jumped in and you spent all that money on the acquisition.
Yeah, I think a lot to unpack there, and that's why I talk to my clients around a lot, is the cost to buy. Generally you're going to lose 5 to 7% on the front end, stamp duty, possibly buyer's agent fees if you're using a buyer's agent, and then you've got the agent fees as well factored in on some of that. And transacting is not a cheap thing to do. But why do you think so many people, I suppose, I see it so often, like people do go into property pretty blind. And then when you think about like buying a car, which is not going to generally cost us nowhere near as much as a new house, but I don't know. I see so many people just they like look at buying a new house like they're going clothes shopping and pull the trigger, $500,000, $1 million, and sometimes they haven't done really any due diligence whatsoever. I know some people personally within my network who bought a property recently, didn't even have a conveyance to look at the Section 32, and then found out that there was issues with connectivity of was it the plumbing or the sewage, or there were certain things that weren't connected to the new land. 25 grand they're looking down the barrel of. And so I don't know why that is. People are so complacent around it. Like what have you seen, or can you put your finger on any particular reasons? I
think that people just think that throw a dart at a dartboard with Australian property and you're going to do well. And maybe that's come down to the fact that that's probably been the case over the last kind of, or the post-COVID era, that you pretty much could have bought anything and you probably would have done well. But you are right in that's why we think it's so critically important, because people, I mean, historically, even myself as a young investor, I had no idea, just shooting from the hip. Hey, can I buy? Yes, so I go and buy. or your friend went and bought a $600,000 property in location A. So you go and ask your broker if you can do that. Broker says yes, so you go and do it without understanding the impacts of what that does for the next one, or what that does for your cash flow, what that does for your aspirations of buying that owner occupier one day.
Yeah. And I think because, well, funnily enough, I bought my first home at 21 as well. Moved out with my wife. We bought our first home at 21. And a lot of that, you don't have any clue what you're doing for the most part.
Yeah, of course.
And we're talking about, doing your due diligence and taking some time to buy a property. But, we actually went to an auction for this property. Had never been to one in our lives. We didn't even have pre-approval from the bank. So talk about going in blind.
Yeah, well,
that was us.
Yeah.
And then unfortunately I was new to the advice industry at that point in time. There was a mortgage broker in the business. So they worked us through finance it. But I just...
Did you buy it?
Yeah, we bought it. Yeah. There was another bit of there. We had the paddles.
Without pre-approval. Your first purchase.
And I literally had no idea what we were doing at that point in time. Like no one was showing me the way. I wasn't really speaking to anyone. Just didn't have the right people around me. But I
was lucky. My dad is or was and still is a conveyancer.
Right.
So I had some help in terms of I had free contract reviews, and he would review strata reports for me, and he'd been doing it for 20 plus years at the time. So he knew. But it was obviously a different time as well. You could get him with the 5% deposit, and if you could fog up a mirror, you'd probably get a loan.
Yeah.
And so obviously the times have changed and changed even rapidly at the time of recording this.
Yeah, due diligence is important. But I guess for a lot of the clients you guys would be working with through game plans is that they're looking at building property portfolios. So not necessarily buying a home and living in, although that can be a part of it. For the most part, it'd be property investors, yeah?
Yeah, but sometimes property investors are property investors with the whole purpose of home ownership aspiration.
Sure.
Like you mightn't have the ability to go and buy your $2.5 million property in leafy suburbs of Melbourne, or any property, probably a dump in Sydney. And lots of investors would try and invest their way to get that, invest within their means, potentially going down that rent vesting model, if you like, to go and acquire one or two properties and then eventually sell them down, because hopefully the capital growth would outperform their ability to save their way to the deposit, or eventually get into that owner occupier with a lower LVR, sort of to make it more manageable from a cash flow point of view. So owner occupiers are still definite users of the platform, but primarily, yes, for property investors to try and build out that roadmap moving forward.
Yeah, why don't we talk briefly on rent vesting? Like, I'm a fan of the strategy. I've done it for a period of time. Like you, sort of family was a trigger point for me when we had our first child, was a point of then going back into an owner property. Mind you, if my wife would let me, I'd go back to rent vesting.
Oh, so would I.
I would do that. So would I. I would do it straight away. And that's, I think, the important part of the owner occ versus investment property journey. Like with the owner occ, there's a lot of emotion tied to that decision. It's not always actually about the numbers. And particularly when I approach that with clients, like, okay, we can look at the numbers every day. What's going to look better from a financial standpoint, but then that doesn't mean anything for the emotional, your lifestyle of where you're living. Do you enjoy it? Where can you afford? So yeah, what are your thoughts around rent vesting? And are you seeing that a lot more amongst the younger cohorts, or even maybe some of the older cohorts? What are you seeing?
Yeah, I mean, up until the budget announcement, I was seeing a huge prevalence, especially in that younger cohort, especially in locations where prices are relatively unaffordable. So plenty of clients, obviously, from Sydney that have really strong incomes, yet can't afford to go and buy the $3 to $5 million property in the suburb that they grew up in. I'm talking about, for example, the eastern suburbs, the North Shore of Sydney, where property prices for entry-level homes in the suburbs that these people grew up in are extremely unaffordable for young professionals just starting out in their career. So they would go down the avenue of kind of doing that rent vesting out. And often we would actually run some numbers in that, okay, you want to go and buy your $4 million property with a 20% deposit plus stamp duty. You need a really healthy deposit, right? You basically need almost $1 million in cash, and then you need to be able to service the $3.2 million loan, which is going to cost you whatever, $25,000 a month in repayments. Whereas if you were to go and rent a similar property, I had a case study with a client. We did exactly this. They lived in a suburb not too far from me, and the property that they were renting, their house just sold a few doors down. Similar properties, they were paying $1,200 a week in rent. Their repayments were going to be 4 times that amount at an 80% LVR.
Huge.
Wow. And they obviously didn't have $1 million as the deposit to be able to get into the property. So obviously, depending on where you are and the price point of the property that you wish to buy, it can or could have been a very viable strategy for property investors, or for just a way to potentially invest your way to that eventual owner occupier.
Yeah, no, I like it because I think a lot of people sort of sit on the sidelines and there's a cost of inaction as well, going, well, I want to live in said location. That's going to cost me a certain amount of money. And if I can't afford it, then I just don't buy. And I see some younger generations out there that are just, they're really not doing anything with their money then because they're like, well, I can't get into that property now. I need to save up X. But then by the time that they save up the deposit, the property's probably gone up at a compounded rate of 5 or 5.5%, maybe even more. So they're never going to be able to even get into it. So I think if you can try and that rent vesting scenario where you rent ideally in that location where you want to live, when you stack up the numbers. When I was doing this at the last point, I did exactly those numbers and looked at the renting v owning that property. Even though I could have owned the property, but I would have tied up a lot of capital in at the same time. It stacked up 100-fold for me. And in particular, you got to look at your life in general. I think for me as a business owner as well, like I value a lot of different things differently. I value my time, so proximity to the office is a real big one because I remember doing a video on and I broke down numbers and said, okay, if my time is worth X, let's just assume that. Right now, when I was living out way in the suburbs, it was taking me, say, an hour each way. Let's just assume that. It was roughly that. Times that out over 5 days in the office. Say there's like 10 hours travel that I'm doing. I cut that down to probably a maximum of, say, 2 hours. And then I go, okay, well, what's my hourly rate then worth?
You just gained a day, right? You gained 8 hours.
100%. Yeah. So, and that's why there's so many other variables to consider, amongst that property journey. And that's the thing. I see these younger generations, they sit on the sidelines and don't realize that, okay, you could just buy a property where you can afford somewhere else. And it's not going to be, you're not going to be living in it. There's no emotion tied to that decision whatsoever. You're just purely doing it from an ROI.
Yeah, exactly. And we'd see often people go and buy an investment property, supplement with some ETFs, and then eventually get themselves to 5-10 years down the track, and they've got a really nice wealth position behind them such that they've got opportunity and that they could potentially make some decisions. Do we divest of the property? Do we divest of some of our share portfolio to put in a much larger deposit on that eventual home? Yeah,
no, I agree. And then what if we stay on the theme then of apartment regular residential property? I think that's a hot one. And what are the traps that you see people fall in with apartments? Because I've seen so many people not make money in apartments. My father-in-law unfortunately didn't. He got sort of scammed in a way 10-15 years ago from an accountant who then put him onto some property spruiker, bought 2 units. You were getting all these tax refunds and things. I think one of them was under like the NRAS scheme, some of those government schemes, and didn't make any money, and just recently sold them, had to bite the bullet eventually and sold them, and virtually flat over that period of time. Opportunity cost of if he just left his money in something else. Even a savings account would have done better over that period of time. So, what are your thoughts there? And when you're looking at the apartment side of things, pros and cons, what are the traps to look out for?
Yeah, look, we unfortunately have had the circumstance where we have seen people, for example, there's one client that always, it's a scenario that always rings out to me when I'm asked about this topic. And this client bought a property in Docklands in like 2016. You know where this is going.
Oh yeah.
Over 10. Oh, this was last year. So over 9 years or whatever it was, negative 1.2% growth. Oh. Strong yield, but absolutely no growth. In fact, negative growth. And the second property that they had was in the city here, and it had 0.5% growth. It was their own occupier, so they were less concerned about that. But again, opportunity cost of 2 assets, and you've had basically effectively net negative growth across both of those properties. And it's effectively just about looking at the scarcity of the asset. So like I was saying, that property that I bought, it was one of very few. It's 5 minutes walk in, and you literally your feet in the sand of Maroubra Beach, which is obviously one of Sydney's best beaches. And so you just want to be obviously where there's amenity, where there's lifestyle, but importantly where there's owner-occupier appeal. And if you're talking about Docklands, where you're one of 500,000 properties that all look the exact same, there isn't that scarcity there. All you need is one fire sale, someone who's forced to sell their property, and now you've set the benchmark for all the properties because they all look identical and they all look the same. Historically, there's been a shift away from strata properties, kind of since that post-COVID period as well. We have seen a huge shift in terms of the data, in terms of where our end users are buying, and they are typically buying those freestanding houses on larger blocks in the regions. But now with yield becoming a little bit more of a consideration, budgets being slashed from a serviceability standpoint, and also just the cost of those entry-level regional properties increasing as well, we are starting to see a little bit of a shift back towards strata-type properties. So again, I suppose the key call out is just really do your diligence in terms of, is it something that has strong owner-occupier appeal?
Yep.
Is it something that is in a low-maintenance block, ideally without the lifts, the saunas, the pools, because you can't enjoy them. And all that's going to mean is you're going to pay X amount of dollars. In some cases in Sydney, we've seen strata levies of like $15,000, $20,000 a year in some instances. You don't want to be paying that because you don't enjoy it, and your tenant's not going to pay you more because of how much strata you pay. So just look for something really low maintenance, but it can be really attractive from an investment standpoint just because of the price point and the rental income.
Yeah, and I think some of the bad cases of that we've seen in the last couple of years is like those big high rises. There's a lot of volume there, and then something goes wrong or there's a defect in the building. I'm sure you've seen it. I've firsthand seen some clients that they've raised like special levies as a part of the body corporate or the strata. Everyone's got to front up 50 grand or more, and the strata or the body corporate raises this money because they've got to put all it back into the building. Have you seen any nasty cases?
Yeah, absolutely. I mean, you only have to look at like Opal Towers or Mascot Towers. I happen to live in Mascot, so that's located geographically quite close to home for me. So you only have to look at those cases where people's, not only their growth has gone backwards, but also their out-of-pocket costs that they're forced to stump up, and it's always just going to leave that building with a huge stigma against it. So again, the key call out there is do your due diligence. Make sure that your trusted professional is doing a really deep dive in terms of those strata reports, and you can understand, and your trusted professional should be able to walk you through the numbers, how much they have in their capital works fund, how much they have in their admin fund. Do they have a healthy balance there such that if there is a roof leak or something like that, that they do have funds to repair that rather than needing to raise a $20,000 special levy per unit owner to get the building back up to scratch.
Yeah, and one of my first property that we purchased, which like I said was sort of captured under this 6-year rule, it's weirdly actually a part of a body corporate, which is frustrating. I actually absolutely hate it. I wish I could get my property out of it, but it's a freestanding home. It's actually on a 1,500 square meter block, but it's a part of a development where there's all of these units. They're about 300 squares. The land, all the land sizes, 28 of them. So they built them all up to this point, and they wanted to keep building them, and the council wouldn't allow them to build them beyond a point. So the developer smacked one property at the top of this hill, which was the property that we ended up purchasing. It's on a 1,500 square meter block, which is big.
But you got strata.
Well, I'm a part of a body corporate. It is absolutely bizarre, but because there's no other service road into my property because it's got bushland around it, I have to go up the common property, and therefore I can't get out of the body corporate. But we're going through an insurance claim at the moment. I did a video on this recently because the tenant left the tap on in the laundry, flooded the whole house. And then, so these are things you don't know. And we didn't even know what a body corporate was when we purchased that property. And now we're going through a claim. And so we're doing a claim directly through Terry Shear with our landlord cover, and then doing a claim now through the body corporate because all of the building is insured through the body corporate. And again, these are things you just don't know. And then we got to pay the excess, worry about all of those things. So there's so many things I think to consider, and I think the key message is really do your due diligence. So I suppose in closing, Joey, around the apartments. So it sounds like apartments are possibly getting back on the radar. Any sort of closing remarks around the apartment side of things? Obviously, doing your due diligence super important. Understanding a lot around the strata, the volume or the size, I suppose, of the complex that you're going in. Any other final points regarding the apartment? Yeah,
really just making sure that it's in a location where there is owner-occupier appeal, and understand where the person presenting you that property is being remunerated from. Because we've seen plenty of cases. Our good friend Kev recently put something online in terms of how he was being propositioned by a property marketer and a spruiker to and to offer them X amount of commission to present properties to their clients. So just really understand where the person presenting you that property is being paid from. If obviously if it's a secondhand property, it's going to be listed by an estate agent, probably pretty good there. But if it's something that's off the plan, obviously fraught with danger for plenty of other reasons, but just understand where that person is being paid from, who's presenting you that property.
Yeah, no, I've seen so many examples of that because I've had people approach me like that exactly as well. They will offer 40 to 50K if we send a client through to them, and they're going to flog them some off the plan apartment or house and land or whatever it may be, and the end consumer is going to pay that. That's just going to be factored into the cost. And I always think about it like buying a new car. You buy the new car, there's stamp duty. If it's a luxury car tax thrown into it. So you buy a car for 200 or whatever it may be, you walk off a lot, it's probably worth 150 or even less. And I always think about some new properties generally like that, particularly the ones in that scenario, because that cost is just getting out into the price, and you're paying stamp duty and things. You're already negative equity from that. You're throwing the agent fees and bits and pieces, and then unfortunately that's where you end up in those scenarios of that Docklands one, seeing my father-in-law go through it as well, where they just don't make money out of it. What about then? You work with buyers agents, so who better to talk about what buyers agents do, or what's the value add of actually working with a buyer's agent? How would you simplify or summarize that? If you're telling a family member, hey, you've got someone who's maybe they've got their principal residence, they've now freed up some money, got the ability to buy another property. They have no idea where to do it. They're time poor, and they go, "Hey Joe, what's a buyer's agent? Why would I consider working with a buyer's agent?" Not that you are a buyer's agent, of course. What would you say?
Yeah, look, the pros are the fact that if you're working with someone that, shameless plug, works with us, you're obviously going to get a property plan, so you can understand, well, why are you actually doing this? Yep. Does this fit in with your long-term objective? Are you doing this to accumulate wealth? Are you doing this to chase some cash flow? Are you doing this for whatever other reason? Because you want to make sure that it does fit into your long-term plans. Yep. And obviously a buyer's agent that does work with us gives you the ability to map that out. In terms of the value, the other value add is obviously the data and the research behind the locations. And obviously the other thing is that the diligence and the negotiation. So, I mean, most people might transact on 1 or 2 properties in a lifetime. Some people never. These guys are doing it day in, day out. So they understand the negotiation tactics, how to deal with the agents so they can keep you far removed. But ultimately, yeah, Australia is a pretty big place to be looking at, and there's multiple different asset classes within the country. So where do you begin to look? And that's where you could potentially employ a professional to not only give you the data and the research behind that location, but also the asset type, and then deliver you that property for the best price possible as well.
Yeah, and then if you look at why people are investing in property, generally it's return on capital, and that either comes through by way of growth or income. What's your approach then around that, and what sort of growth rates are you generally seeing? And if you look at the national, home values and what the average growth has then been, do you have in your mind where there's if a property's not growing at a said rate, then it's probably not worthwhile? How do you guys sort of go about that, and what are you seeing a lot of buyers agents doing that space? Yeah,
look, so I mean, historically we've kind of seen, or we like to use a conservative growth metric somewhere around maybe the 5 to 6% mark. Although we've seen historic price growth close enough to the 7% over the last kind of 30 or so years, depending on where you get your data sources, of course. Some of our partners are delivering far above 5, 6, 7% growth, in some cases double-digit growth, and in some cases double-digit growth over a really long time span as well. So it's obviously potentially buying it under market value, but also buying a location that may have had almost 2x growth in 4 years, for example. That's not uncommon. We have seen hundreds of thousands of dollars of equity of some partners who have delivered some really good quality results for their clients. But in terms of that long-term growth rate, and we're really conservative. So if the clients come to us and they have had 21% growth in 2 years, we immediately put a lid on that. And we'll go, great, I'm so glad you got that. But moving forward, we're going to use this conservative growth rate moving forward, because we don't want it, and it'd be unsafe of us to assume that they're going to get 20% for the next 30 years. So we firstly put a lid in on that, and then to give them a bit of a view in terms of what that might look like moving forward. But yeah, some of our partners over the last kind of 3 years have been averaging maybe even 20% growth in some of the properties that they've bought their clients. But yeah, realistically, we would like to use somewhere between the 5 and 6% mark to be a little bit more conservative moving forward.
Yeah, I have firsthand seen that with working with the likes of Kev, good friend of mine, and he's who a lot of our clients will use his business KTG. And I've firsthand seen that value translated by negotiation, got me into a property I never would have thought about or looked at before because I'm time poor. I'm not going to travel up to Queensland or whatever it may be. And that growth rate has been exponential over a few years.
So someone like Kev, for example, we use 5% moving forward. So you might have had 20%, but moving forward, we're only going to give you 5.
Yep. And then going along with that, so what about talking about the differences between, say, the residential and commercial space? And then how does growth and income differ between them? And then going on with that, when are you seeing people start turning towards commercial? And this is a hot one because of what's come out in the budget recently that we were talking about before, whereby all of the changes to negative gearing and all these proposals that are coming in, they're actually carving out commercial property and self-managed super funds as well, which is quite interesting. But where does commercial come into play? What are the differences between commercial, resi, growth, income? What does that look like?
Yeah, so really interesting. And over the last maybe 2 or 3 years, we had already start to see a little bit of a shift where maybe 4 years ago, if you had to mention the word commercial, someone would have run a mile and just screamed vacancy and looked the other way. Slowly that kind of mindset has been started to shift, and it's actually formed part of a lot of people's plans. So they might have had a plan to accumulate 1 or 2, 3 maybe investment properties over a 10-year horizon, look to hold them for, I don't know, a decade or more than a decade, 2 decades, and then maybe potentially divest of 1 or 2 of those properties and then transition in towards more of a yield-orientated play, which for most investors, naturally the thought process goes towards commercial. That is obviously starting to pick up more prevalence, even more so after the budget announcement, whereby the commercial property is kind of not being impacted as much as the resi space has been. But historically speaking, higher yields, maybe lower growth at the same time. So growth usually pegged to the rents, which if we say rents increase by 3.5% to 4%, well, then that kind of can dictate the growth rate of those assets. Not to say that we haven't seen commercial property do a lot better than that. You might buy something that's vacant, severely under rented, you go and increase the rental income, naturally the value has drastically increased. But yeah, usually more when the client is focused on the income and the return. And also it's going to have to be once you have a pretty decent asset base behind you already, because the barriers to entry are a lot higher in terms of the cash required. And depending on who you speak to, in most cases, usually the more you spend, the better quality asset, the better business that's renting that property within the commercial space, rather than you might be able to pick up a property for 500 or 600K in the resi space, whereas your kind of entry level might be a little bit higher in the commercial avenue. But yeah, typically higher yields, maybe lower growth. But the other big difference is the yields are net rather than gross in the residential space, in that usually, depending again on the lease, the commercial tenants pay for lots of the outgoings that we pay for as residential investors. And the main difference as well is that you are leasing the property to a business rather than a family. So typically a little bit less kind of, I don't know, maintenance and whatnot that usually falls in on the business. But the downfalls is usually where the vacancy comes in. So just wanting to make sure that you do allow some buffers in place to cover those period of vacancies.
Yeah, lot to unpack there, because I think that's something that is overlooked. Like with residential property, sure, you can get the income, but then you've got to strip away a lot of the costs that are associated with that. So you might see the headline of 2, 3, or maybe 5%. It's not unrealistic in certain areas, but then you strip away land tax, agent fees, you throw in some maintenance costs year to year, maybe there's some strata and other bits and pieces, throwing your tax rate on that, and it really quite easily eats away at that return. But like you said, with commercial, then you're looking at a higher net rate of return. So would it be unrealistic in commercial, say, getting sort of 5 to 7? Would that be a comfortable range, you would say?
Yeah, and I'd probably say like 5 is more metro, and then the more regional you go, you could bump that yield up. But obviously, the more regional you go, you're exposed to a little bit more risk. But with risk comes reward in terms of the yield. Most of our partners modelling in yields somewhere around the early 5s to 6% mark. Again, because like lots of the purchasing that they're doing is closer to metro areas, and again, you get a nice 5.5 to 6% net yield. It's going to look a lot better from an income point of view rather than a 4% gross yield in the resi space.
Yeah, and I think this is something that's always overlooked with property as well. Like, people don't think about property like the share market, but I try to think about property like the share market. There's hundreds of suburbs around Australia that you can be buying in. Those markets are all doing different things at any one point in time. You can't, slap all the property market together in Australia and go, well, this market's going up at 5%, so why this market should be doing the same thing. Like Melbourne right now has been really struggling in the last couple of years for a lot of different reasons with what the government's been doing. I am seeing a lot of people start buying now in Melbourne, a lot of BAs as well. But then you compare that to the likes of like Queensland, Perth, you've seen like a huge amounts of growth over the last couple of years. And that's where I think most property investors or investors in general go wrong, is they have this home bias. They live in a certain location. They don't think of they can invest anywhere outside of that. So you take a 40, 50K radius of just where they live, and they probably end up buying investments in those locations. And as advisors, diversification, 101. And I think it's even more important with property because you're buying one single asset generally. You could buy an apartment complex or whatever it may be, but you're generally buying one single asset. If you already own your home in this suburb and you're literally buying another home in the exact same suburb, you're like putting all your eggs into the one basket. And that's where I think people really go wrong. But talking about that, but then plus with commercial property, because there's different types of commercial property, like industrial, office, like we own this building that we've recently purchased. So are you seeing, what does that look like between, when you talk commercial then, like different types of commercial, and what are some of the differences that exist there?
Yeah, strong prevalence towards really low maintenance stuff. So more your industrial factory, like a concrete floor with a tilt panel doors to keep things relatively low maintenance, and also, and really importantly from the client point of view, is that it could be multi-purpose, right? It could be used by not only many different businesses, but different industries, rather than if you were to buy something that is very niche, you're then kind of compromising your potential tenant pool. And it's similar in terms of like the same thing in the resi space, right? If you go and buy one of 500 in a skyscraper, you've got that risk. Whereas you could do the same thing in the commercial space. You could see a really nice juicy yield, but you're buying a 20 or a 12 square meter office in the on Collins Street here in the city. And again, that kind of functions in the similar way to buying a high rise apartment would. And you may see compromised growth. You may see longer vacancy periods in the commercial space as well. So a really strong shift and preference towards multi-tenant, multi-purpose, and relatively low maintenance, be it in industrial factory or something along those lines.
Yeah. Price points. What are you seeing with price points for commercial? Where most people are transacting around? Where's it starting at?
Yeah. Look, it can obviously be in the hundreds of thousands, like sub a mil. We are seeing a little bit of that. Lots of our users who are buying commercially are usually buying a mil plus. So somewhere between maybe 800-ish to like 1.6, because that's where like most of your, I suppose, your mum and dad investors can afford to get into. But then if you can push above the $2 million mark, that's when you've got a little bit less competition, because your mum and dad investors usually don't have the $700,000 plus to get into that type of asset. And it's not quite where your big funds want to be playing in. So there's a bit of like that $2 to $4 million range is where there's a bit of a sweet spot that lots of our partners are purchasing for their clients. But it doesn't mean that you have to, right? You can potentially get into something at a lower price point. But like I said before, and I'm just repeating partner rhetoric, the more you spend, usually the better quality asset you'll get. And in most cases, the better quality and more reputable tenant you'll have in your space as well.
Yeah, it makes sense. And what if we then shift into like, what are you seeing good investors do? Like, what does a good game plan look like? When people are using your software, they're working with their buyer's agent or the professional, whoever that may be. Like, what would you say is the fundamentals of like a good property game plan?
Yeah, really understanding your why. And I know it's spoken about all the time, but I'm super fascinated and passionate about making sure you understand what your why is. And I always ask the client first up, like, why are you doing this? Like, what is it that you're trying to achieve? Is it even realistic? So sometimes the whole purpose of using game plans is to understand, is your goal even realistic, or are you dreaming? And maybe you need to realign some of those expectations. But ultimately, it's about, like I said, understanding the why and then seeing, does this property actually get you closer to that goal or get you further away? So what a good game plan looks like, it's modeling in making an acquisition, understanding the cash flows, the consequences of buying a property with a 3% yield versus a 5% yield. And then when you can safely and comfortably afford to jump into the next one that best suits you and your risk profile, model that next one in, be it in 3 years' time, if there's enough equity in the portfolio, or if it's in 5 years' time. And so for me, it'll be acquiring a couple of resi acquisitions. And then maybe if you can afford to buy and hold them, fabulous. If they've got some value add potential as well, because we can model in doing cosmetic renovations, granny flat additions, for example, even better, because that's going to improve either your capital value or your rental yield, or both. And then potentially looking at what divesting of an asset could look like to pay down some owner-occupied debt, to reinvest into a different asset class, to maybe go and help you buy that owner-occupier.
Because I think for the most part, people go into it quite blind and you haven't thought about what that exit plan, actually is. I think those things are incredibly important, because it's like really you're preaching to the converted here. As an advisor, that's what I have to do. Is really understand the why of why do we want to go into this, and whether that be property or another form of investment. Like in my opinion, it's never just doing one thing. It's kind of doing a lot of different things. And if a lot of my clients are involved in business, so business is usually going to be a big part of their wealth, but they're not building up all of their wealth through business. So we start taking profits out of that, or income, building up the investment portfolios, shares, etc. But then, that property element does give you more leverage exposure. And if we then talk about, that property versus shares, how do you explain it? Not obviously putting you on the spot because you're not an advisor or anything of sorts, but you have people throw that to you. Does that come up often around, property? Do I invest in shares, or why property? And what do you think?
Look, I think people are pretty educated, at least now anyway, in that like lots of, especially younger investors, lots of them have had exposure to ETFs over a number of years. So people are starting to understand, like mainly from an affordability standpoint, I can't afford to go and buy a property, but I want to invest. So I'm going to invest into the share market. I suppose for me, it really comes down to the main difference in my view is obviously leverage and control, I suppose. You can be a little bit more granular in terms of, well, you could add value to that property. If that's your skill set, you might be a chippy or a tradie, and you could go and buy something that's run down and add value and increase the capital value or the rental yield, whereas obviously you can't do that in the share space. But for me, it's really about the leverage and taking a small amount of your cash to control a much larger asset. I know obviously you can pull equity out and do that in the share space, but that's the primary difference that I see. But we often do see clients, and plenty of them, that have really substantial share portfolios, and this is just adding to their suite of investments.
Yeah, and I think a good point to add around that one is around the shares and the property side of things, and for investors, not putting all of the eggs into one basket, obviously incredibly important there. But what about if you talk about what are some of the bigger mistakes you've actually seen people make? Of course, not using specifics of what their scenario is, but where have you seen people actually go wrong in property? And have they generally made those mistakes before they're getting advice, or what are some of the bad? Yeah,
I'd say people are probably coming to a buyer's agent or a mortgage broker, for example, one of our partners, and they're usually trying to rectify a past mistake. And it usually comes down to asset selection. So they might have bought that off the plan apartment that's done no growth. I've had, unfortunately, too many people that bought in a mining town, for example, where they chased, they saw a 13% yield and thought this is too good to be true, saw a little bit of growth as well, maybe doubled down and bought another one. And then the BHPs or whatever move out, and then all of a sudden there's the rental yield drops to a 2.5% and there's no tenant to move into that property. So it usually comes down to asset selection, sometimes over leverage as well, and so getting a little bit too property giddy and wanting to do X, Y, and Z, particularly at the time of the 1.99% interest rate a couple of years ago, and then they fixed into an IO loan, and then they roll over to P&I, and all of a sudden we're talking about a 6% interest rate, if not more than that, and then not understanding the cash flows and not stress testing their own budget. So usually it's probably one of those two things that's kind of hamstrung them or kind of potentially triggered a forced sale or the opportunity cost, like we were alluding to before.
Yeah, no, well, I think that's where people can lose in property, because first of all, property doesn't go up in a straight line. All markets operate differently. But that's one thing I really preach to clients. If we go down the property route, cash flow is incredibly important, and we want to make sure there is space so that, if interest rates go up, we're in an interest rate, hike cycle as we currently speak, or other variables happening in your life, that cash flow is not going to be tight to the point where you can't make your mortgage repayments, and you might be put in a position where you are forced to sell the property. And as you spoke about before, when we had those low interest rates during COVID, seeing some people go out and get some real low rates, and then we've seen the fastest rate hike cycle we've ever seen, and unfortunately seen people who then come through to me after the fact that, like, hey, we've got this property, we can't afford it, we've got to sell it. And when you're selling in property within a couple of years, people can usually smell and see that desperation. Because you just have to look online.
You'll see the past sale.
You can see what it was last year. You're like, oh, they're selling within 2 years or 1 year. It's like, okay, there's probably a bit of negotiation to be had from this part. So that's where I think people do need to be really careful, because if you're forced to sell, that's where you could be selling at a loss, factor in your costs on the upfront, your stamp duty and all those bits and pieces.
It's a hefty negative.
It's not a nice one. So Joe, you mentioned a point earlier around making money in property, because the traditional way I see people invest in property is just buy and hold. You buy a property, you sit on it over a period of time, you don't really do anything about it or do anything with it. It's more of a lazy way of property investing. I personally like doing it. I don't really want to get too involved in any of my properties, because, again, talking about where my time is best spent, it's usually with the business, in front of clients, or I want to spend time with my family. I don't want to have to think about property renovations, developments, but I have seen people make money out of that. I've particularly seen builders do that from time to time, where they, it's probably not easy on the family, where you buy the principal residence, you get it, you fix it up, you offload it, you pay no tax, you rinse and repeat. I've personally seen people do that before. But what other ways are there, other than the simple buy and hold? You mentioned, renovations, or you buy a property, maybe you do throw a bit of cash around, a bit of paint, cleaning up the gardens and things like that. Do you see that strategy much? And what other strategies are there that you're seeing for people buying property?
Yeah, really commonly is buying like the ugliest house on the street. Something with a really nice sturdy build and like a pretty decent roof line, and potentially changing the configuration within that existing roof line. It's like a simple 2-bed into 3-bed, or 3-bed into 4-bed, or can you add an ensuite somewhere? Just these little small things can add a significant value in terms of the equity uplift, but also it can drastically change your rental income. You add an extra bedroom, in some places you're adding $100 a week to your rental income, which is obviously going to be like $5,000 to erect a gyprock wall, relatively small outlay to get a pretty significant uplift in terms of the rental income. So that's a really common one that we see. There's a little bit of a shift now towards granny flats for some of our partners who are exploring that option, not necessarily to increase the value of the property, and they're going in knowing that, because in some instances, depending on who you speak to, it can actually detract from the property's end value, because not everyone wants to go and buy a property with a granny flat in the backyard, because you might want a soccer pitch for your kids to go and play with, or you might want to go and put in a 20-meter lap pool, for example, and now you can't do that. But what it will, in most cases, if you do it right, do is increase the rental income. So you could still be buying in a great location where the yield might be relatively soft, go and spend a couple $100,000, $200-300, depending on where you are and how much you want to spend on the granny, to then get a significant uplift in terms of the rental income. So that's another, strategy that's getting a little bit more traction at the moment. What's always been quite attractive but fraught with the most amount of risk is, say, something like a subdivision. So buy a older home on a big parcel of land, knock it down and build 2 houses side by side, or build townhouses on them. Usually, like I said, you're going to get the most amount of uplift, but fraught with the most amount of risk, because all you need is 1 or 2 things to go wrong for your gains to be dwindled away. In terms of the commercial space, you can still do that as well, in terms of adding increased net lettable area, be it adding a mezzanine, for example, and then you're increasing the amount of net lettable area, which will increase the rental income, which increases the value of the property as well. So there's a lot of different ways in which you can come in and add value to increase your bottom line, or potentially just buying something that you can see that's under market. You can look at comparables and go, well, this here, even if I do nothing, it's buying it relatively under market value, and there might be some equity there on day one for you.
Yeah, and every now and then I come across clients that want to flip properties. I'm personally a massive fan of that, because you can make money out of it, but like you got to do it right. And I think the point that which your software then does model is like those exit costs on getting out of property. Like you got your taxes, agent fees, and they're the things that, although you can make a decent amount of money in a short period of time, then you whack on all of the taxes to that and possible changes to capital gain.
Exactly.
Coming through, it very quickly erodes what that actual return can be. But getting to a bit of a closeout, if someone's thinking of buying an investment property next sort of 6 to 12 months, someone comes through, having a chat with, say, a BA or a buyer's agent or an advisor, what would you be saying to them, and kind of where to start? Yeah,
now more than ever, obviously with the budget changes as well, is come in and do a strategy first. Map that out. We've recently, in fact, just a couple of days after the budget was announced, uploaded onto the platform the new CGT changes, the negative gearing changes as well, so we can show you what the negative gearing change looks like in terms of the accumulated losses, and when that starts to run a positive cash flow return, you basically wash back until you've covered until you've recouped your previous losses. Or if you trigger a sale, we add that back as a tax credit upon selling the asset down. So we can actually show you the differences. But basically putting that in a roadmap, and just asking your broker, your advisor, your buyer's agent, if they do offer something like Gameplan, so you can actually come in and visualize it before you jumped in to acquisition, because cash flow, especially right now, is critically important in this high interest rate environment, and potentially without some of the negative gearing benefits. You really want to stress test your numbers and make sure that you can afford to hold the thing, because I'm of the same belief as you. Property is a long-term game, right? You want to be buying these things for decades, not 15 minutes. So really just stress test your numbers, because the last thing you want to do is be a forced seller, especially in a tricky or unknown market.
Yeah, no, I think well said, Joey. And a final point I wanted to touch on, like, you've probably, how many portfolio's do you reckon you've seen? Probably
almost 12,000.
12,000 portfolios. What are some of the better ones that you've seen, or maybe what are some of the better ones you've seen, and why? And then what's
I can answer that.
Some of the bigger ones.
Yeah, I can answer the better ones, and the better ones are the bigger ones.
Yeah.
But for me, and I actually did this not long ago. We pulled some user data, de-anonymized everything.
Yep.
We just used suburbs, not the address within the suburbs. And I actually looked at someone earning like the lowest. I think it was earning about $100,000 of income, like the best portfolio that we'd seen accumulate. And it was just someone that bought their first property in 1997 and then just slowly kept accumulating. And that was one of the best portfolios, but it was just time. Like they acquired in 1997, 2001, 2007, 2010, 2013. Fabulous portfolio. Cash flow was always kind of bubbling along,
Yep.
really nice portfolio value. And that was on someone that never earned a crazy income, not a BA that runs a 7-figure business or an 8-figure business that can afford to go and do these things.
Yep.
In terms of some of the bigger ones, I had a session not that long ago actually with a client who had 45 properties.
Jeez. That's a few.
Yeah, that's a few. And so, but again, these are like this person runs a very successful business.
Yep.
And so I love to kind of pull apart the data that we have. And our average portfolio value is around 1.5 million across our users. That's the median value of the portfolio, 1.5 million, up from 1.3 a couple of years ago. So you can kind of see the shift in the portfolio size. But our top like 5% of users, and we've got to remember, like if you're doing game plans, you're probably like an investor that's a serious investor to go to the level of utilizing our software. So we'd like to think we're like the top 1% of the 1%, and our top 5% have a portfolio value greater than 5 million.
Okay.
So you can see that the vast majority of investors have maybe 1 or 2 assets, maybe their home, maybe 1 investment property with a total portfolio value of around 1.5 million. So not these $45 million portfolios. Sure, they exist, but they are definitely the outlier and the minority.
Yeah, 45 properties sounds like 45 headaches.
Yeah, absolutely.
I reckon that person's probably got a full-time employee managing that property portfolio, because that is that's a lot to worry about. And I think that's a key thing to remember. Like with property, there is a lot more involved. There's pros, there's cons. With shares, you don't have to worry about tenants flooding your home. Kicking holes in the wall.
I just got an email before about the toilet seat has just come off on one of my properties.
Yeah, and sometimes you get professional tenants that literally won't put a screw in the wall.
Yeah, and I was like...
And you got to pay handyman.
They just said, do you want to bring a handyman? I was like, did the toilet seat break?
Yeah.
Or has it just popped off and you can simply pop it back on again? But the other thing as well is that, and this is what I love doing, is understanding if a client has a goal of X, how many properties do you actually need to get there?
Yep.
And we ask them the question, how many properties do you think you need in your portfolio? The amount of people that say 10 plus is outrageous, 10. Right?
Yeah.
10 all the time, but probably 2 to 4, depending on your goals and your purchase prices. In most cases, 2 to 3 assets could probably get you where you want to be, coupled with any other investments that you've got, is probably going to be more than enough to achieve what you want to achieve through property. Yeah,
totally agree. And I think obviously the structure is really crucial, and that stuff that does get modeled through game plans as well around. And I'm sure you've seen plenty of times they might have some individual names, some via SMSF, some in trust, maybe some in company, and getting that structure right is obviously critical, because that particularly has an impact on that net return, particularly on the income, and very much so with the budget coming out. All of that's going to be under the microscope, because you have negative gearing goes, then that's going to change things big times. But all of that's done through game plans and helps people make essentially the best possible decision they can, knowing all of the facts before clicking go and buying a property, which is just always risk.
And absolutely. And then we're dynamic as well. So when things do change, come back in, because like to have one static report, like if you had done that 3 weeks ago, your plan could be very different today.
Yeah.
Based on the change that we've just seen, let alone interest rate rises, rental income changes, and things like that as well.
Yeah, no, it's good to hear, Joey. Well, for the listeners, where can they actually find you? You've got a podcast going as well?
Yep. So you can tune in on Spotify or YouTube or wherever you get your podcasts to the Property Strategy Podcast, where I interview buyer's agents, no bias at all. So like I'm happy to chat to anyone and everyone. Property advisors, mortgage brokers, financial advisors, a demographer I just did a recording with yesterday as well. So just to give a property investor a well-rounded view in terms of what different property strategies are, listen, see what resonates with you, pick this. You don't like that? Cool. Take the parts that you like, disregard the ones that you don't. And if anyone wants to reach out, it's joey@gameplans.com.au, or you can follow me on LinkedIn, where we occasionally put some content out there as well.
Yeah, so I guess if anyone is engaging with a buyer's agent or another professional and property is involved, I think it's definitely worth looking at the game plan software, because I've personally seen it and used it, and it's really good stuff. But then making sure that your professional is using it as well, and maybe not just modeling out of a spreadsheet. And just you don't even know if some of those figures are actually true and correct. And I think that's a good point. But you're actually the first official guest we had on the podcast, Joey. So this is a pretty exciting time.
Privilege.
It's a pretty exciting time, mate. So we're not fully set up, but you're down here. We've made it happen. But I actually thought of one thing I want to do with guests moving forwards, and I'm putting you a little bit on the spot. All right. So hopefully you can pull it off for us. But I thought it'd be good to ask any guests that we have then come on, like, what's the best piece of advice you've actually ever received? Now, that could be property related, because we're just talking all things property in investing, but it's, I think, something that I've virtually just thought about on the spot right now that I'm literally going to be asking every guest now. I'll give them a heads up next time, so I didn't give you any sort of a heads up. But yeah, I don't know, if you can sort of reflect on your journey thus far, plenty of time ahead. Is there any sort of key advice or something that stood out for you that you were told along the journey, or even if you could tell your younger self in a way, but what, I don't know, what's one piece of advice that you've heard, or maybe it was your father as well?
Yeah, for me, it was just about taking action, and like taking action when I was 21 rather than when I was 31, because I would have been in a drastically different position if I'd have waited an extra decade.
Yeah.
So for me, that was critical to take action when I could, as young as I could. Obviously, I had great support, so that was really, really beneficial. But for me, it was a quote, and I think I'm stealing this from Warren Buffett.
Okay.
And so I'm glad I'm the first guest, because I'm sure plenty of people wanted to use this as well. But someone planted a tree. Well, you know how that phrase goes, right? Yeah. So like, obviously, take action now. You're not going to get the gain right away. But if you plant that seed, it's going to grow into a tree that's going to provide shade for you and your, hopefully, future generations as the years go by. That's my personal investment philosophy. When I first read that, and I was like, that's beautiful. I don't want to get rich tomorrow, but I would love to do some really small things now, take some sacrifice, plant that seed, slowly nurture it, water it so that it grows into a nice tree to provide shade for myself and future generations to come.
Yeah, I think that's a great way to finish, because, like, you know, we're a similar age. Like, some of the younger generations, and even some of the older generations I see these days, people just want things like that.
Yeah.
And they don't want to put in the work. They don't want to wait. They want it, you know, wanted it yesterday. And I think there's so much to be said in, like, just patience, keeping things pretty straightforward and basic as well. Like you said, that, you know, what's one of the better portfolios you've seen? That's that person that just slowly chipped away and accumulated, do any fancy subdivisions and anything like that. I think there's something to be said in that. But Joe, mate, really appreciate you being on the Winners Playbook and the first guest on the podcast, which has been awesome, mate. And mate, hope to get you back on again another time.
Thanks for having me on. Looking forward to it.
Cool.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.